Welcome back to the Pro Ticker Podcast, your Tuesday morning edition, covering major financial magazine headlines, everyone. We are jumping into a deep dive today that really captures the absolute duality of the modern economy. You've got, on one hand, just generational capital pouring into technology, and then on the other, well, geopolitical risk is hardening trade lines all around the world.
That's exactly right. We've pulled together quite a stack of reports here from CNBC, Bloomberg, Reuters. And our mission, really, is to give you the clear signal amid all the noise. We're focusing on two main things today: the unprecedented scale and, frankly, concentration of capital in this AI infrastructure build-out, and then the increasing friction points we're seeing in global trade and monetary policy.
Right. And if there is one story that just perfectly encapsulates both the, staggering ambition and the financial risk of this moment, it has to be this massive AI partnership that went down recently. I mean, we're talking about a deal worth up to $100 billion, sealed with extreme speed. And it's juxtaposed against these really serious concrete warnings about the future viability of the entire AI revenue model itself.
Yeah, it really is high-stakes poker, except the chips here are data centers and entire power grids. It's wild.
Okay, so let's unpack the structure and just the sheer scale of this monumental deal between OpenAI and Nvidia. According to CNBC, Nvidia is set to invest up to $100 billion into OpenAI, and it's specifically earmarked for building these enormous next-generation AI data center infrastructures.
Yeah, and the detail that really caught my eye, and it tells you so much about the current pace of this tech arms race.
Yeah.
It's the negotiation style. Sources are describing these hurried, late-night, one-on-one negotiations.
Yeah.
Just the CEOs, Sam Altman and Jensen Huang. And critically, like you hinted, no investment bankers involved at all. They sealed this handshake deal worth potentially $100 billion, apparently while they were both involved in President Trump's state visit to the UK, just a week before the actual announcement.
That's incredible. It almost feels like a piece of high-level government diplomacy or something. It suggests this AI build-out is now being viewed as, a geostrategic asset, something demanding political oversight, maybe.
It certainly has that feel. And, this relationship isn't brand new. CNBC reminds us that Huang personally delivered NVIDIA's very first DGX supercomputer to OpenAI way back in 2016 when OpenAI was still a nonprofit. So that trust, it runs pretty deep.
Okay, so the trust is there, but what about the actual infrastructure they're planning?
Well, the scale is just breathtaking, really. We're talking about building systems that require 10 gigawatts of power.
10 gigawatts?
10 gigawatts.
Yeah.
And to give you a sort of real-world anchor for that, CNBC sources estimate that's roughly equivalent to the entire electricity demand of New York City on a hot summer day.
That's insane.
It is. And that infrastructure, it'll rely on somewhere between 4 and 5 million of NVIDIA's top-tier GPUs.
Wait, 10 gigawatts? That is just incredible. We're literally talking about AI infrastructure needing its own state-level energy policy here.
Pretty much, yeah.
And the financing structure, it has to reflect that sheer size, right? How does the $100 billion actually flow?
Right. It's not immediate. The initial chunk is $10 billion, and that investment is locked in at a $500 billion valuation for OpenAI.
Okay, $500 billion.
But then the following 9 rounds, each for $10 billion, they'll be priced at whatever OpenAI's valuation is at that time, so potentially much higher.
Ah, okay. So built-in upside for NVIDIA if OpenAI keeps growing, but OpenAI gets the capital committed now.
Exactly. And this structure immediately creates what expert analysis in the CNBC Daily Open is calling a very virtuous cycle. Think about it. NVIDIA invests capital into OpenAI,
which OpenAI then turns right around and uses to buy chips, systems, hardware from NVIDIA?
Precisely. The money cycle's right back. It's sort of self-funding, you could argue, and that could potentially reduce the initial financial risk for both of them.
Okay, the virtuous cycle sounds efficient on paper, I guess, but doesn't it just cement OpenAI's reliance on one single vendor? I mean, wasn't the whole point recently about diversifying away from its original primary partner, Microsoft? It feels like they're just trading one potential lock-in risk for another here.
Well, that's absolutely the core tension in this whole relationship, isn't it? And get this, OpenAI apparently only informed Microsoft, who is, remember, their principal shareholder and primary cloud provider, just a day before the deal was signed.
A single day? Ouch, that sounds risky.
Very risky. But look, their diversification strategy seems real. It's just incredibly expensive. Remember, this NVIDIA deal comes just weeks after source material confirmed OpenAI agreed to spend a staggering $300 billion.
$300 billion with Oracle.
Yep, $300 billion on computing power with Oracle, starting in 2027. That's under their whole Stargate infrastructure plan. So they are trying to build these redundant competitive supply lines. But yeah, it means managing a whole series of increasingly prickly, massive relationships. It's a real juggling act.
That juggling act is just incredible to think about. The market, though, seemed to love the clear commitment to just building stuff. After the news dropped, Nvidia stock jumped, what, nearly 4% on Monday?
3.93%, yeah.
Yeah.
Hit a new 52-week high, and it helped drive the Nasdaq Composite to a record close too, according to Yahoo Finance and CNBC.
And that optimism spread, right? It wasn't just Nvidia.
No, it cascaded globally. We saw a whole chip stock rally. Companies like TSMC, SK Hynix, STMicro, basically anyone connected to Nvidia's supply chain got a boost.
Makes sense. But that must have immediately raised concerns elsewhere in the tech world, right? About supply constraints.
Absolutely. Bloomberg specifically reported on this. Nvidia had to come out pretty quickly to assure other customers, saying, look, this $100 billion deal won't affect general supply. It won't change our focus. They maintain that every customer, whether they have an equity stake or not, is still a top priority. We'll see if that holds true.
Okay, so that phenomenal investment flow, that huge spending, it leads us directly into, well, maybe the brutal reality check regarding financial viability. We have all this enormous enthusiasm for spending, but what about the actual future returns?
Right. And there's a stark report on this from the consulting firm Bain & Company, which Bloomberg covered. They estimate that by 2030, AI companies collectively will need something like $2 trillion in combined annual revenue.
$2 trillion just to cover costs.
Just to cover their soaring computing costs. Yeah.
Wow.
And here's where the analysis gets really, really critical.
Yeah.
Bain projects that industry revenue is actually likely to fall $800 billion short of that $2 trillion target.
An $800 billion shortfall per year.
Per year by 2030. That's the projection. And, that projected deficit forces us to seriously question the sustainability of these massive valuations we're seeing and the current business models that are supporting this huge infrastructure push.
Yeah, that's a huge gap.
And it's important to remember, even OpenAI, the poster child here, is currently losing billions. They only expect to be cash flow positive by 2029. That's still years away.
Right. That funding gap is a really serious structural risk just lurking beneath all this excitement, isn't it?
Definitely.
Yet, despite these, tech-specific concerns, the broader global economic outlook is looking surprisingly resilient, maybe. The OECD just provided some pretty sunny forecasts, according to reports in Reuters and CNBC.
Yeah, they did. They actually upgraded their 2025 global growth forecast to 3.2%. That's up from the 2.9% they estimated back in June. And for the U.S., growth expectations were lifted, too, to 1.8% from 1.6%.
Okay, so what's driving that resilience, then, especially with all the trade tensions we hear about?
It seems to be a few things. Continued fiscal support in China is one factor. The strong U.S. investment related to AI, which we just discussed, that's another. And then, importantly, this effect called front-loading of industrial production and trade. Basically, activity that happened ahead of recent higher tariffs kicking in.
Okay, let's clarify that front-loading concept because it sounds pretty critical. What exactly is it, and why is it driving growth right now?
Yeah, essentially, it's a pull-forward effect. So companies knew these higher tariffs were coming, right? So they rushed to import goods, think stocking up shelves, fulfilling industrial orders before those higher duties took effect.
Ah, okay. So you get this temporary surge in trade numbers.
Exactly. It provides a temporary boost to the metrics, but it might be masking a potential slowdown later on because you're effectively borrowing sales and activity from the immediate future.
Got it. And that front-loading activity brings us right to the tariff shock itself then. The OECD explicitly warned that the full effects of the recent U.S. tariff increases haven't even really been felt yet.
That's right, which means we might not see the true economic impact for, several more quarters. The data shows the effective U.S. tariff rate on imports climbed to an estimated 19.5% by the end of August.
19.5%. That's the highest rate since where? 1933.
Since 1933, yeah. It's a staggering return to protectionist levels.
So that raises a big question. What is China doing in the face of these really high U.S. tariffs? Are their exports just collapsing?
Well, no. Bloomberg reports they're essentially just rerouting their massive export engine. Instead of shrinking overall, China's actually heading toward a record $1.2 trillion trade surplus this year.
Oh, record surplus. How?
By flooding other markets with cheap exports, specifically targeting places like India, Africa, Southeast Asia.
So their solution isn't to slow production, it's just to change the destination address for the containers.
Pretty much. But, that massive export explosion is causing really serious friction globally now. This is essentially dumping selling goods below cost to grab market share. And you're seeing countries like Mexico talking about slapping on defensive tariffs, maybe as high as 50%, on Chinese products just to protect their own local industries.
Wow, 50%. So the trade wars are just shifting geography, not ending.
Seems that way. And this whole trade dynamic, it affects local monetary policy everywhere. For instance, CNBC noted that Singapore's core inflation just hit a fresh four-year low in August, fell to just 0.3%.
0.3%, that's really low.
Very low. And this eases the pressure on Singapore's monetary authority to keep their interest rates tight. It actually reinforces the case for them to potentially loosen policy, maybe as soon as October. Especially because that temporary boost they got from the front-loaded export activity, it seems to be already fading out.
Okay, so transitioning from global trade turbulence to more direct political intervention, Reuters has this really fascinating report on the U.S. Treasury Secretary Scott Bessent. He's pledged large and forceful actions to stabilize Argentina's wobbling currency, the peso, and potentially using the Exchange Stabilization Fund, the ESF, which is what, over $200 billion?
Yeah, the ESF holds about $219.5 billion currently. It's this powerful, almost legendary tool. It was created way back in 1934 during the Great Depression, specifically for stabilizing currency markets like this.
Okay, so it's designed for this kind of thing. And Argentina's assets have taken a big hit recently.
They have. So this support is seen as a boost to the peso and maybe the government standing ahead of their midterm elections.
Yeah.
But, and there's a big but, the key concern that analysts are raising is the lack of conditions attached to this potential action.
Why is a lack of conditions so dangerous, particularly in a country like Argentina with its history?
Because it risks basically just financing capital flight. Think about it. Using the ESF injects U.S. dollar liquidity into their system. Now, without strict conditions on how that money must be used, the worry is that local elites, or anyone with means, will immediately use that slightly more stable currency access.
To get their money out of the country, convert pesos to dollars and send them offshore.
Exactly. Given Argentina's history, we're talking over 100 years of serial defaults, hyperinflation investors have this deeply embedded urge to flee during any crisis. So, unconditional support could simply end up financing their exit rather than stabilizing the domestic economy long term.
Right. Markets definitely have long memories when it comes to Argentinian volatility.
Okay, let's switch from foreign policy intervention to domestic regulatory concerns here in the U.S. CNBC covered a significant Supreme Court development. In a 6-3 order, the court allowed President Trump to temporarily remove Rebecca Slaughter as an FTC member. Yeah, this is actually a potentially massive development for the independence of regulatory agencies. What the justices are really considering here is whether to overturn a very old precedent from 1935 called Humphrey's Executor.
Humphrey's Executor, what does that precedent do?
Currently, it shields members of federal agencies like the FTC, the SEC, others from being fired by the president simply at will. They need sufficient cause.
Okay, so what's the real-world implication then if that 1935 precedent gets overturned? What changes?
Well, the fundamental stability and independence of the regulatory landscape could change dramatically. It would essentially move agencies like the FTC from being these quasi-independent regulatory bodies to being agencies completely controlled by the policy whims of the sitting president at any given time.
So much more political influence over regulation.
Potentially, yes. The dissenting justices warned exactly that this could hand the executive branch full control over these crucial antitrust and consumer protection bodies. And that has huge long-term implications for, enforcement consistency, market stability, business planning, everything really.
Definitely something to watch closely then in terms of regulatory risk. Okay, finally, let's wrap up with the Federal Reserve. What's the latest there?
Well, all eyes are on Fed Chair Jerome Powell. He's giving a highly anticipated speech on monetary policy later today. This comes, of course, after last week's first interest rate cut of the year, so everyone's listening for clues about what's next.
Right, and there's key data coming out later this week, too.
Yep, on Friday we get the big one, the Fed's preferred inflation gauge. That's the personal consumption expenditures, or PCE index.
Why do they prefer the PCE index over the CPI, the Consumer Price Index, which most people hear about more often?
It's mainly because the PCE covers a broader range of consumption, things like healthcare spending paid by employers, for example. And crucially, it uses a dynamically weighted basket of goods. So, as people change their buying habits, maybe switching from beef to chicken, if beef gets expensive, the PCE reflects that shift more quickly than the CPI's fixed basket. The Fed sees it as a more comprehensive, up-to-date gauge of underlying inflationary pressures.
Got it. Makes sense. So what's the general mood among Fed officials right now? Are they signaling more cuts are coming soon, ready to ease further?
The message seems pretty divided still and definitely cautious. St. Louis Fed President Alberto Musalem came out recently and explicitly cautioned against expecting rapid rate cuts. He said there's, quote, limited room for easing further.
Limited room. Okay.
Yeah. So that suggests that while the market might be hopeful after that initial cut, the central bank is still really wary about potentially reigniting inflation if they move too quickly. They're pumping the brakes on expectations a bit. Hashtag outro.
Hmm. That caution really reflects the overall duality we've seen across pretty much all these headlines today, doesn't it? We've got this explosive, truly generational investment pouring into AI infrastructure, leading to record stock highs for some companies.
Yeah, huge enthusiasm there.
But simultaneously, we've uncovered these really serious financial viability questions for that whole sector. Plus, you've got ongoing global trade turbulence driven by protectionism and dumping.
Right. And central bankers globally being very careful, pumping the brakes on expectations for rapid rate cuts or easy money returning soon.
It's just a very complex, very mixed signal market right now where that tech exuberance is constantly battling these structural, economic, and geopolitical headwinds.
That sums it up pretty well.
So we've laid out the whole landscape for you. The massive $100 billion Nvidia-OpenAI deal, the potential $800 billion AI revenue shortfall looming, the unfolding global tariff shock, the ESF intervention, the Fed's caution. Here is a final provocative thought for you to chew on as you go about your day. Given that Bain report predicting that massive $800 billion AI revenue shortfall, and recognizing that investment is currently driving this whole cycle, how long can that virtuous cycle of investment between companies like Nvidia and OpenAI really sustain the industry's enormous compute ambitions before the hard reality of profitability demands fundamentally shifts the entire build-out strategy?
That really is the multi-trillion-dollar question for the next decade, isn't it?
Indeed it is. We'll see you all tomorrow morning with new headlines from major financial magazines.